You've been Googling how to get into finance for about 3 weeks now, and you've seen CeMAP, you've seen DipFA, you've seen something called RO1. Then there is CeRER, which I can never pronounce, that's popped up. And then someone on Reddit told you to look at insurance qualifications. And now you've got 23 browser tabs open. You've nearly bought 3 different courses, and you've watched a man on YouTube telling you that he made 6 figures in his first year, and you still got absolutely no idea which one of these things you're actually meant to pick, which one's going to work. So let me save you the next 6 months of head scratching. These qualifications are not the same. They lead to very, very different jobs. They pay very different money, to be completely honest with you. And the day-to-day work feels completely different depending on the job you choose. And every single website who's trying to explain them to you is also trying to sell you their course at the bottom of the page, which is exactly why none of them ever just tell you straight what it actually does. So for the next 10 minutes or so, I'm going to walk you through every single main finance qualification that you'll come up against as a beginner in the UK. We're talking about CeMAP for mortgages, CeRER, the one I can't pronounce, for equity release, DipFA, and also RO1 to RO6 routes for financial planning, and the insurance qualifications to sit alongside all of that too. For each one, I'm going to tell you what it actually is, what the career it leads to is, what kind of money you can realistically earn, and what the work feels like day to day, what the stress is like, what the evenings and weekends look like, and where it can take you 10 years from now. See, by the end of this video, you'll have a picture nobody else is laying out for you. You'll know which lane fits the life that you want. And hopefully by then you'll be able to close those 23 tabs and just start. So let's get going. So the quick bit of context before we dive in, because once you understand this, the whole thing makes a lot more sense. The whole UK financial industry is run by a regulator called the FCA. Okay, that is the Financial Conduct Authority. They're the ones who say who is and isn't allowed to give financial advice. And they don't just hand out a single license that lets you advise on everything. They split it all up completely. Mortgages have their own qualification, equity release has its own, investments and pensions have theirs, insurance has its own. So when you're picking a qualification, you're not really picking a course, you're picking a license. And the license you pick is going to decide what kind of advisor you can become. See, that's it. That's the whole thing. Once you've got that in your head, none of this is confusing anymore. So let's go through them all in order. First one you have is CeMAP, which is the mortgage one. Now, CeMAP stands for Certificate in Mortgage Advice and Practice. It's the qualification that you need if you want to give advice to people on buying houses. There are 3 modules, no entry requirements, no degree needed, no finance background needed. You can be a postman on a Monday and start studying CeMAP on a Tuesday. That's, to be honest with you, the whole point of it. Most people, they get through it in about 4 to 6 months at a sensible, reasonable pace. So studying for a few hours a week around their main job, maybe looking after their children, stuff like that. Some people do smash it out in like 6 weeks if they go full time, but either way, it's the easiest, fastest, cheapest way to get a proper FCA recognized license to give regulated advice. And once you've got it, you become a mortgage advisor, sometimes also called a mortgage broker. It's exactly the same thing, by the way. You just sit down with people who want to buy a house, you work out what they can afford, and you find them the right deal from across the lender market. Alongside that, you also advise on protection. So that's things like life insurance, critical illness cover, income protection, family income benefit, all of those things. And this is honestly where the big chunk of the money in your job is going to come from. Now, money-wise, here is the honest truth on this one that people don't like to talk about. If you had to work for a bank or an estate agent as an employed advisor, you're probably looking at about 25 to 30 grand to start with commission on top. Now, a decent experienced advisor inside firms tend to land somewhere in the 40 to 60 grand range all in. And then there's the self-employed lot. They're completely different. And that's where it all gets very interesting, because some self-employed brokers, they can earn 30 grand a year, but some of them can earn 150. Some earn even more than that, okay? So it's the same qualification. The difference is the structure, not the knowledge. Now, the lifestyle is actually one of the best in finance, in my honest opinion. See, most self-employed mortgage brokers I work with run their entire businesses from a home office. The job is busy in spring and autumn, quieter around Christmas, hours are flexible. If you set them properly and stay in control of it, the advisors absolutely smashing it are working 4-day weeks, they're earning 6 figures, and the ones drowning though are doing 60-hour weeks and earning half of that. Okay, it's the same job, again, different setup. The stress level is moderate, there's compliance, there are case files, you can be checked, but you are advising on one type of product. You become genuinely good at one thing. You're not predicting markets, you're not gambling with someone's pension. The work is contained. You see, you can build your own brand. You can hire a small team. You can stay solo and earn really, really well. It's the most flexible starting point in this industry, basically, in my opinion. So now we have the one I can't pronounce. That's CeRER, which is the equity release specialism. Now, understanding that here's one that most beginners never have even heard of. I can't even pronounce it, like I said. And it's quietly becoming one of the most interesting niches going at the moment. See, the CeRER stands for Certificate in Regulated Equity Release. It's a tiny qualification compared to CeMAP. It's only 2 units. 1 2-hour exam, often done in a couple of weeks of focused study. But the thing is, you can't actually start with this one. You need to have CeMAP first. CeRER, which CeRER, I'm going to call it whatever it is, sits on top of CeMAP. Think of it as a specialism you add on. It's not a way into the industry, you see. What it does let you do, though, is it lets you advise on equity release. And that's a type of mortgage for older homeowners, usually 55 plus, who want to pull tax-free money out of their house without having to sell or move. Now, this whole world of what they call later life lending is helping people fund their retirements, helping grandparents give money to their grandkids who can't afford to get a deposit for a house, paying for care, clearing old debts before they become a problem. Here's why it matters more than people realize. We've got an aging population. Care is very expensive. Property prices are even more expensive. They're sky high. Younger generations can't get on the ladder without help. It's becoming nearly impossible. And all of that has made equity release one of the fastest growing parts of the whole industry. Lending hit $2.5 billion last year and it's climbing significantly. And there's not enough qualified advisors in this space to meet the demand. Now, money-wise, equity release advisors generally earn more per case than the standard mortgage. In fact, it's quite significantly more. The cases are usually bigger. The work is more involved, though. Experienced full-time equity release specialists can comfortably earn into the 70s and well past it. Some do exceptionally well, by the way. Equity release is not for everyone. You're often advising older, sometimes vulnerable, in fact, often vulnerable clients. The products affect what they leave their kids. It affects family conversations. It affects long-term plans. The compliance is really tight, and the advice has to be careful, slow, and considered. It's not a kind of high-volume churn through the cases job. It's a sit down for a long, careful chat over a cup of tea. It's that type of job. And if that sounds awful, this is definitely not the path for you. If that sounds genuinely meaningful, this might be the most rewarding niche in the entire industry. You see, lifestyle is calmer than the mainstream mortgage brokering with this. It's generally kind of fewer cases. In fact, there's a lot less cases most of the time. Appointments are longer, often home visits. Lots of advisors describe it as the most properly advisory part of the whole industry. Less form filling, more actual conversations. Now, long term, this space is going to grow significantly. Older homeowners aren't going anywhere. The demographic shift is locked in for the next 20 years. And the CeMAP plus the CeRER advisor with a decent introducer network can build an incredibly stable, well-paid practice. It's quietly one of the best lanes in the business if it suits your personality and the access to the leads. We now have DipFA, which is the financial advisor one. Now, this is where we're stepping to a completely different level. DipFA stands for the Diploma for Financial Advisors, and it's a level 4 qualification, which basically means it's harder, longer, and a lot more in-depth than CeMAP ever is. It typically is going to take you 9 months to a year to get through, but what does it let you actually do? Well, pretty much everything to do with money that isn't mortgages. So pensions, investments, ISAs, retirement planning, inheritance planning, tax stuff, protection, the lot. Now, a mortgage advisor has one main conversation. A financial advisor has a whole conversation, a holistic conversation. They're the person that you call when your nan dies and you've inherited some money and you don't know what to do with it. They're the person you call when you're thinking about retiring and you've got 6 different pension pots from 6 different jobs that you've worked at over the last kind of 20, 30, 40 years. So now let's talk about the money. You see, new financial advisors usually start somewhere around 30 to 40 grand. Once they've got a bit of experience and a client book, 60 to 90 grand isn't unusual at all. Now, senior advisors and self-employed financial planners with mature client books can regularly earn well into the 6 figures. At the very top end, it is genuinely like very big money. We're talking hundreds and hundreds of thousands of pounds of income. So why does it pay more than mortgages over the long term? Well, mortgage advisors earn a lump sum when they place a case, but financial advisors, they earn an ongoing fees on them they manage for those clients, which means as long as the client stays with you, you get paid every month, every year, and that book builds and it compounds. And after 10 years of doing this properly, you've got got a recurring income stream that pays you whether you work this month or you don't work. And this is the bit that nobody tells beginners at all. The stress level is meaningfully higher. Okay, you're not placing a single product in a single moment. You're holding the long-term financial future of many families at once. Markets go up, markets go down. Clients ring you in a panic when the news is scary. The reports on compliance you have to write is much longer. The technical knowledge you need is significantly wider. There's just more weight to all of it. Lifestyle can be lovely though, but the work is heavier. Longer meetings with clients, more research, more report writing. Some people thrive with that depth, but some people will miss that cleaner, more contained nature of mortgage work. You also have the RO route, which is the other route into financial planning. Now, this is the bit where a lot of people get confused because RO1, for example, and the RO kind of stuff is a separate qualification. It's the first unit RO1 is of a different version of the same destination as DipFA. Now, stick with this one because this is where it gets a bit confusing. There are two main awarding bodies in the UK finance. There is the ILBF, which does CeMAP and DipFA, and then there is the CII, which does its own version of the financial advisor qualification. Now theirs is called the Diploma in Regulated Financial Planning. It's made up of 6 units, and they're labelled RO1, RO2, RO3, RO4, RO5, and RO6. Now, when someone says I'm doing RO1, what that actually means is I'm doing the first unit of the CII Financial Advisor Diploma. RO1 is regulation and ethics, the foundations. RO2 is investments. RO3 is tax. RO4 is pensions. RO5 is protection. RO6 is the case study at the end where you bring it all together as one. And it leads to exactly the same job, full FCA permission to advise on investments and pensions, same money, same lifestyle, same career. So why would you pick this one then over the other one? Well, there are 3 things why you do it. First, study style. DipFA has a chunk of coursework, but the CII route is mostly multiple choice exams. So if you hate exams, absolutely hate them, DipFA is gentler. But if you hate writing essays, then the CII route is gentler. Second one is the DipFA is usually quicker, 9 months to a year. But the CII route can take 12 to 24 months because of the modular structure. Third is the long-term prestige. See, the CII route leads more naturally into a chartered financial planning status, which is one of the most respected designations in this industry. If you want to become a chartered advisor one day, the CII route is the cleaner path to do it. Honestly though, most firms accept both. They don't really care. Pick the one that fits how you like to learn. Now we've got insurance qualifications. So this is the last one, and is the path that nobody really talks about, which I think is a bit daft because loads of people would actually love this lane if they knew it existed. Insurance has its own family of qualifications, mostly run by the CAI. The entry level one is the Cert II, which is the certificate in insurance, and is a level 3 qualification, similar in difficulty to CeMAP, and you can usually crack it in about 3 to 9 months around the job. Now, what does it open up? It allows you to open up a whole world of insurance broking with the knowledge behind it, helping businesses or individuals find the right cover. Underwriting, so being the person who assesses the risk and decides what to insure and what to price. Claims, which is handling things when something goes wrong. Account handling, so managing relationships with corporate clients. Specialty insurance in the London market, which is the high-end stuff with companies like Lloyd's. Now, money-wise, the entry-level roles tend to start around 25 to 35 grand. Experienced underwriters, though, and brokers in commercial insurances often sit in the 50 to 80 round, and senior London market specialists can earn well into the 6 figures, as you'd expect, okay? The very top end, niche specialty underwriters with deep experience and expertise, they earn really serious money. But that's a long ladder to climb and very hard to keep on top of it. Now, the stress level depends entirely on the role. Personal stuff is fairly process-driven and predictable. Commercial and specialty work has higher stakes, but it's especially around the kind of big renewals and major claims, but it's a different kind of pressure to financial planning. It is transactional rather than emotional. Now, here's the thing about insurance that's totally different from everything else we've talked about. It's a corporate career. You'll usually be employed in the other insurance type of stuff, not in the personal stuff. It's going to most likely be office-based or hybrid with set hours, hourly pay, pensions, bonus structures, clear paths from junior to senior. If you want a proper grown-up job with stability and structure, this is by far the most traditional lane in finance. Long-term, insurance is rock solid. It's not going to go anywhere. It pays well at senior levels. The career ladder is clearer than self-employed advice. It has less explosive upsides and much more stability. But it is completely different. But doing it yourself on personal insurance, you can do that on your own. You can earn a lot of money. You don't actually need a qualification for that. So look, you've sat through all of that. Now here's how I'd actually stack these up. If you asked me to sit down, I was in a pub with you, and you asked me what I'd say. If you want the fastest, cheapest, easiest way into giving advice, CeMAP is going to be the way. Genuinely, 3 to 6 months and you are qualified. Nothing gets you advising clients quicker. If you want the highest long-term self-employed earning potential, DipFA or the DipFA or the CAI route into a financial planner is going to be the route. It's going to have recurring income, compounding client books, big money over time. If you want a specialism that has more per case and pays more per case, but has a huge demographic tailwind, equity release route is the top. But if you want proper, structured corporate career with stability and benefits, the true insurance side is going to be go through the CERT CII to start and then build on from there. If you want the most variety in work, financial planning is pretty good. Every client is a very different puzzle. If you want mastery of one craft and you want to be genuinely brilliant at it, mortgages all the way. You can become world-class in mortgages in like 3 years. Now let's break down stress. Stress, honestly, lowest stress is going to be insurance for sure. Okay, they're pretty predictable. They're easier to do, and there's not much stakes going on. Middle of the pack, I'd say, is mortgage advice. It is real, but it can be contained if you have the right structure. And then higher end is definitely going to be equity release. The advice is heavy. It's absolutely hinged around family dynamics and all of these other things. That's going to be up there. And then the highest in the, not just in my opinion, in obvious kind of objectively true at this point, is financial planning. The breadth of knowledge and the actual long-term responsibility and the market exposure is the most weight to carry in this entire industry. And there's a reason why it's the kind of king of the hill, so to speak. Now, it doesn't mean financial planning is bad at all. It just means it's a heavier job. Some people love that weight, some people don't. Now let's break down lifestyle. And the most flexible of this by miles is going to be a mortgage advisor, self-employed, by sure. Like, you can do what you want, 4 days a week, earn 6 figures. It's genuinely all doable if you set it up right. Now, the calmer, more advisory route is definitely going to be that equity release. You know, you're going to have fewer, deeper cases, but it's going to be heavier with a great long-term upside. Self-employed financial planning, there's going to be way more report writing, more depth, but more stable and traditional, which means that over time, you're going to be able to kind of build a more stable income. And then obviously the corporate insurance roles, if you want to do that, that's not really my kind of cup of tea, but over that, that's absolutely fine. Now, there's no objectively best lifestyle one. Obviously, the lifestyle is the one that fits you, but it's knowing which one is right for your situation. But here is something that none of these websites that you're seeing online that are flogging you the courses they ever mention, right? Passing the exam is not the end. Every single one of these qualifications has real-world apprenticeship phases after the textbook is complete. For mortgage advisors, you need to spend 3 to 6 months under supervision before you're allowed to advise independently. Same for equity release. Same for financial advisors. And I'm pretty much sure it'll be the same for insurance roles as well. Whoever you work for has to sign off your early cases until they're satisfied that you actually know what you're doing. So anyone telling you that you walk out of the exam and you're going to go into a 6-figure income next Monday, they are selling you something else. They're selling you a dream. The qualification is the door. The door doesn't make you good at the job. The work after the door does. So where you'll actually be in the next 10 years is really important to consider. Let's take CeMAP over a 10-year period. You're a self-employed mortgage broker. You've got a brand in your local area, a content engine, bringing in clients, maybe a small team helping you out, and a steady book of clients who remortgage every few years and refer their mates. See, that's easily a comfortable 6-figure income, 4 days a week if you want, like I said, and it's genuinely good life. Now, if you take the equity release route and then take that 10 years from now, you're a later life lending specialist. You've got fewer cases, bigger fees, deeper client relationships, a network of solicitors and financial planners feeding you work, calmer pace, strong income, properly meaningful work, helping older clients through real life decisions. Now, if we take that financial planning route, 10 years, let's have a look at that. So you're a financial advisor with a mature book, reoccurring income, strong 6-figure income, option to stay solo or build a firm and earn proper serious money if you want to do that. See, all of these are good lives, but they're just different lives. But the bit that actually matters is the bit that nobody on the internet is telling you. Because what they don't want to tell, because like I said before, they're just trying to sell you courses. Pick one that matches the actual life you want. Not the one that looks impressive on LinkedIn, not the one that sounds the most exciting. The one that fits how you want your weeks and your life to feel 5 years from now. If you want freedom and mastery and the fastest route into advising clients, then go for CeMAP. If you want deep, holistic advice and the highest long-term earning potential, you need to go for financial planning. Okay, you have to do that. If you want that high-value specialism with a demographic that is building, but you need to be, really sit with them and spend a lot of time with them, then obviously equity release is the way. If you're still sat there after this video and you've still got all those tabs still open, then here's the bit I'd want you to actually do. Close them, pick a qualification that matches your life to whatever it is that you want to do for the next 2 years, register, book your first exam, start the work. You're not going to figure this out by reading more. You're going to figure it out by starting. And if you've watched all of this and you reckon CeMAP is the lane for you, good, because that's the type of thing that I help people do. Not CeMAP, but as a broker. And that's the one that most people in your shoes really should start with. And the next video that I recommend you watch is on this channel is the honest guide to CeMAP for complete beginners. And what I do is I walk you through exactly what the qualification is, how the exams actually work, how long it really takes, the mistake most beginners make as well when they first start doing it. So if you want to watch that, click on it. It's on screen right now.